Very good morning, everyone. Hope you all are doing good. Am I clearly audible and visible? Yes. Okay. Thank you. All right. So welcome back again in this series of editorial analysis. Today we have a very important news or editorial which we are going to cover, right? So you might have heard about unaffected price method, which is to be implemented from 1st of June in 2024 only by SEBI. So it is there in the editorials, and apart from it I have taken up two editorials today, okay, because in every newspaper today there was this news of RBI dividend which we have covered yesterday only. So all those analyses are coming daily, so we will not repeat them. So I have taken two editorials which I thought would be important for you. Could not get it? Okay. But you will get it today, okay? You will understand everything about this today, and then we'll be taking up another editorial as well. So let's get started. This is your first editorial. This is taken up from the business line, okay? So you can go to the newspaper business line, you can read this editorial or view or column, and then you can come back to these slides, right? Then after that you will be able to understand this entire editorial, what is it talking about, right? So let's see. It is very important and very technical as well. We'll try to understand all the points. Now, as you can see, the heading or the title which I have put in is the unaffected price. Unaffected price. So basically, and here you can see a move to shield investors against market rumors. Shield means protect, right? So SEBI wants to protect the investors, to protect the financial market from rumors. This is something which you all agree that there are rumors in the stock market, right? Due to which there are price fluctuations or there are fluctuations in the share market, right? So it is due to these rumors that there are volatility, and this volatility in the share market leads to imperfect decisions, say, okay, so changes in the investor decisions related to this market. So how does SEBI plans to protect the investors from these kind of rumors? Rumors are false information. What are rumors? Rumors are false information, okay. Yeah, might be due to election results as well, but even when there are no elections or there is no period of election going on, still stock market always suffers from rumors, right? And it affects investors, it affects our money, right? It leads to shocks in the stock market. So this is a plan of SEBI which becomes very important for you when you are preparing for the exam. What is it? How will it impact? Okay, so we'll go a bit technical. I have also incorporated the formula, although I think it is not needed, but then if we are understanding any concept, if you know something, you should know it by heart, okay? Otherwise, half knowledge is always harmful, as you all know, right? So this is the initiative by SEBI, that to keep the prices unaffected from the rumors. That's why the title unaffected price, okay? So SEBI's unaffected price framework will protect investors from making risky investments and ensure market integrity. Let's see how this comes out to be, okay? So this is from business line. You can read the article. Now, so here is the title, SEBI's unaffected price framework will protect investors. What is it? How it will protect the investors, right? So in the landscape of any stock market, rumors spread like wildfires. You all will agree with this, that be it any stock market, need not be stock market of India only, any stock market suffers from a chronic problem which is rumors, false informations, right? Which is spread like a wildfire, spreads very quickly and covers a large extent, okay, leading to volatility, fluctuations in the market and fluctuations in the share prices. So fluctuations in the market means fluctuations in the share prices only. Now, why are we concerned about these fluctuations? Because these volatilities or fluctuations often lead to irrational investment decisions. Why do we want to contain these fluctuations? What is the concern behind these volatilities or fluctuations? The concern is that because these fluctuations are not based on real facts. We are talking about rumors. So when you have rumors, you have false information, and when there is false information, the fluctuations are also not substantial, or say they do not have a proper authentic background, right? So these fluctuations are unnecessary. When unnecessary and unrealistic fluctuations are there, it leads to irrational investment decisions. And irrational investment decision means, it might mean loss of money. Are you getting my point? So this is why SEBI is concerned with these rumors, and that's why this new framework has been put into picture, and it will be implemented from 1st June 2024. Okay, let's see how it goes. Creating an unfair and unpredictable market environment. Recognizing these risks, based on these risks, SEBI has unveiled a new framework for calculating the unaffected price of the securities. That's what the title and the thumbnail is. Okay. So SEBI has unveiled a new framework, a new methodology through which we will be calculating the unaffected price of the securities. Now remember this unaffected price. What will be this unaffected price? Unaffected means price of shares which is not affected by the rumors. Are you getting my point? Price of shares which is not affected by the rumors, so that we can trade on the actual prices, not on the basis of false informations or fluctuations which are due to false information. Are you getting my point? So this is the initiative. Now this framework by SEBI, which is to be implemented since June, aims to calculate the securities price, aims to calculate all the securities, say every security of a financial market, stock, shares, everything. So calculate securities price had the rumor not existed. So the author is saying that what is the aim of SEBI in this initiative? SEBI wants to calculate that price of the share or stock or the security which is there had the rumor not existed. If there was no rumor, what would have been the price? So that is the unaffected price. Okay. For example, if price of say one share is 150 rupees, for example, just basic example, 150 rupees, okay, but due to any kind of rumors which we are concerned about and talking about in this article, say the price goes up to 250 rupees, okay. So this change of 100 rupees is the unnecessary fluctuation, because it is not based on real events, it is based on rumors, false information. So the unaffected price would be 150. Are you getting my point? Unaffected price would be 150. The affected price is say 250. Okay. So this fluctuation we want to contain. Are you able to understand till now? Yes? Yes. Okay, it will have a huge impact in Indian market. And you know what, we have been discussing in previous editorials that investors are looking more to Indian economy, domestic investors are having confidence in Indian economy, right? We have discussed FII, FDI, everything else. So it would boost the investment environment as well. We will attract more foreign investment, which is good for us. So let's see. Then this is your background of the information. Now, what actually it is? What is this unaffected price? How it will be calculated? So what is the core of this information? Okay, what is it? So it basically involves, okay, it basically involves it is a multi-step process. So it involves 3 steps. Okay, there will be 3 steps in which SEBI will be dealing with this mechanism, right? What are these 3 steps? Just try to understand very carefully. Okay, so first step, as you can see here, identifying instances of significant price fluctuations. So in order to calculate the unaffected price, you first need to have to understand or find out where are these significant price changes happening, right? So you first find out the phenomena. You target the phenomena that okay, it is here that you can see these are huge fluctuations that can be due to rumors. Are you getting my point? So first step is you need to identify. Identify what? Identify instances or cases or phenomena of significant price fluctuations. Wherever they are, there is substantial price fluctuation. So it might be attributed to rumors. That could be due to market rumors. So you first need to identify such things, such cases. When you have identified such huge fluctuations, now what to do? So this is according to the SEBI, what SEBI is planning to do, right? So first step done. Second step, calculating an adjusted volume weighted average price. Now don't get haunted by this word or this concept. I'll explain what is this VWAP is, okay? So need not worry about that, just try to understand. So first you have identified the problem, where the problem lies, okay? Then calculating adjusted VWAP. VWAP is volume weighted average price. So basically this VWAP, first we'll try to understand VWAP, then I'll explain this second step to you again, okay? So what is volume weighted average price in financial market? It is a very important term in financial market or often used by SEBI. So it is basically to calculate the price changes, okay? So let me explain what is VWAP first, then we'll come to second step again. So VWAP, volume weighted average price. So it basically takes into consideration the price as well as the volume of shares traded. Are you getting my point? So it is a very wholesome concept, right? Volume weighted average price, VWAP, volume weighted average price. So let's understand what is it. Basically the VWAP represents average price. It represents average price at which a security, for example a stock, has traded throughout the day. So it primarily reflects you what is that average price, because price changes, so we take out the average, right? What is the average price at which any security, for example a stock, has been trading throughout the day, in the entire day from opening time to the closing time. What is the average price on which a stock or any other security has traded? First thing, okay, weighted by, but it not only represents the price or the average price at which the stock or security has traded throughout the day, but it also takes into consideration the weighted average of volume of shares traded at each price level. So given the price that okay, at this price of the share, at this price of the share or security, this much volume of the shares have been traded. So VWAP is basically this formula which represents you that what was the average price at which the security was traded entire day, okay, between opening and closing time, also the volume of shares traded. So weighted by, it also has a weight of volume of shares traded at each price level. So at each price of this security, what was the volume as well? So it is a very wholesome concept. It gives you the reality of shares traded and how much traded, at which price more volume traded, right? So all these kind of calculations you can do from this. Is it clear to you all? What is VWAP? This much is clear? Although it is a bit technical, but I am trying to simplify it for you as much as possible, okay? I hope you got it. The first paragraph, this one. A broader understanding of VWAP is, of what VWAP is, right? Okay, good. So now it provides a more accurate picture of average price. It provides more accurate picture of average price. Why? Because it considers both price and trading volume. It considers both price and trading volume. So not only prices of the shares are reflected, but also at which price how much volume of the shares was traded is also reflected, right? So it is a very important formula. Now, if we dig into its calculation, very simple, nothing complex, just try to understand the formula. It's up to you if you want to remember or not, okay, but I have incorporated it so that you can understand what exactly VWAP is, because now SEBI will be implementing it in June, so it will be news all it will be flooded in all the newspapers, right? So whenever you read these news, you will be able to understand what VWAP is. Calculation. What is the calculation for this concept or formula? So first thing, multiply the number of shares traded at each price level by corresponding price. So first what you need to do is multiply how much shares traded with each price, okay. So multiply number of equity shares traded at each price level by corresponding price. So what is the price, and at each price level how much shares have been traded, right? Then sum up this product. So when you multiply this, then you take the summation of it. Sum up these products for all price levels. So when you sum up, you get how much volume of shares traded at all price levels. Are you getting my point till this point? So first you have multiplied number of shares, okay, at each price level. Then you summed them up, you did the summation to get total volume of the shares traded, okay, at all price levels, total volume of shares traded at all price levels. Then divide this total sum, the total which you got, divide it by the total number of shares traded during the day. Divide it by total number of shares traded during the entire day, okay. So why are we dividing it by total number of equity shares traded during the day? Because it is giving you that this was the shares traded during the day and this was the volume at each price. So it will give you the fluctuation due to price. Are you getting this or not? Just let me know so that I can proceed further, or you want me to explain it again? Because the entire news is this only, okay. Gurleen Kaur, can you please take an example with the formula? Example will be, you know, if I take imaginary or say numbers, it would be very vague to calculate. You can take any number, okay. So this is your formula, you can put any number in this formula, you can get the answers, but it would be very vague to do such calculations, right? Clear? So it is nothing, just try to understand that this is what you do. You have taken all the shares which have been traded, multiply them with the given prices, okay, and then sum it up, okay. So you got the summation. Why summation? So that you can see all the shares traded, the volume of the shares traded at each price level, okay. Then you divide by entire shares which have been traded, total number of equity shares traded, so that you can see the price fluctuation. Are you getting my point? You can see that at which price the volume was how much, right? So basically you try to figure out these calculations from the formula directly or indirectly. So broadly this is it. Then you to simplify more, you have this formula as well. So this is summation of xi into yi. Now what is xi? What is yi? Xi is the number of equity shares traded at price say yi, okay. So suppose that number of equity shares traded at price yi, okay. So let me take an example as well for you. So suppose the price is 10 rupees, okay, of each share, and 100 have been traded. 100 have been traded. Are you getting my point? So Gurleen, I am also taking the example, very basic numerical, so that you can also calculate it. Just try to do this calculation. Everyone stay tuned, try to do this. So I am saying that the number of equity shares traded are 100, which is your xi, okay, into price of each share is say yi, which is 10 rupees, okay. So what did you get? What did you get? The product which you get is, first you need to multiply this xi into yi, multiply this. Okay, what is the product? Let me know very quickly. 100 into 10, simple calculation. Why are you taking so much time? Anyone? Okay, right. All right, so here you got the product, but then you need to do the summation. This is your summation of what? All such prices. Are you getting this formula right now? Because I told you that at 10 rupees, this much was traded. The price might be say 15 at a point of time in the entire day. It might be 20 at a point of time in the entire day. It might be 30 at a point of time in the entire day. So you multiply all the xi into this, then xi into this. All the shares traded at their respective prices, you got all these things, whichever prices were there, you multiplied it, then you did the summation, this part, summation. So you get total volume of shares traded at every price level in the entire day. So now you understand, through this formula you will be able to find out, okay, at this price there was a huge volume of say shares traded, or at this price there was the lowest volume of shares traded. Why is this fluctuation happening? Are you getting this point? It must be more clear now, right? Then you divide it by summation of xi. Summation of xi. Xi is nothing but your total shares traded at the given price. So then you divide the entire summation with the summation of xi. So adding up all the shares traded in the entire day. This gives you the formula known as VWAP, volume weighted average price. Now it is very clear, right? So you get to know that at each price this was the volume traded. So when you get to know that at each price this is the volume of shares traded, you get to know the fluctuation as well. So you cannot address the problem unless you find out the problem, right? If you want to address the problem, you have to find it first. So where will you find it? In this formula. Okay, this much volume at this price, this much volume at this price, this much fluctuation can be due to rumor. Are you getting my point? I don't know if they can ask you the formula. I think it is important, that's why I included it, right? So I cannot say clearly that yes or no, but I think that it is important. So you should remember this, okay? We should prepare on a safer side, that's my concern. Because something which is in news, something big is happening, so you should be at least aware about it, okay? We are not just preparing for the exam, you should prepare to understand, to increase your knowledge, to increase your understanding of what is happening around you, right? Exam is just a part of it, so your aim should be bigger, that's my concern, right? So this is your formula. This formula is clear to you all? Now moving ahead. So this is VWAP. Now whenever I say VWAP or volume weighted average price, so it is this price, average price at which the volumes of shares have been trading entire day. You should understand that I am talking about this formula whenever I say VWAP. Now let's get back to the slides. So second step which we were discussing about is that, so you have find out the fluctuations first, then second step we were discussing was calculating an adjusted VWAP. So we have done VWAP. Are you getting this point or not? We have done VWAP. Now the step is to calculate adjusted VWAP. You all know what the word adjusted means, right? For example, when we say that GDP is adjusted for inflation, GDP is adjusted for inflation, so in that case we mean real GDP. That means we are deducting the impact of inflation on the GDP figures. Are you getting my point? So adjusted means you reduce or subtract the impact of the variable which you are considering. Is this clear? So when we say adjusted VWAP, we are saying that we then calculate VWAP subtracting the price fluctuations, okay, for the security. How does it is it done? It is done by excluding the price impact. Same thing which I said, excluding the price impact of rumor from standard VWAP calculation. We have seen the standard VWAP calculation, isn't it? The formula which we have seen right now. This is the standard VWAP calculation used in financial markets. Yes or no? But due to rumors or due to fluctuations, there might be price changes. So you reduce or you eliminate those price changes from the standard calculation which we have done, then you will get the adjusted VWAP. Adjusted VWAP will be the unaffected price only. So first you calculate the standard VWAP, okay, the VWAP formula, using the VWAP formula. It will give you, it will reflect how much fluctuations are there. You eliminate the fluctuations, you get the adjusted VWAP. Is this clear to everyone? Shall I proceed further? Yes? Okay. Very good. Take it. Then third step. So you have done this, okay. Third step, you use this adjusted VWAP. You use this adjusted VWAP, adjusted for these rumors, impact, price impact, impact of the rumor, impact of the fluctuation, okay. Use this as the basis of determining the unaffected price. Now, using this adjusted VWAP, you will be able to determine the unaffected price of security. Because now you have two figures. One which has impact of rumors or price fluctuation figure in it. Another, when you reduced the price fluctuation, you get the original figure. So that original figure which we are calling as adjusted VWAP is a standard which you can use now to calculate what would have been the unaffected price, and unaffected price is nothing but the price without the rumor. So that's how SEBI plans to implement this entire methodology. Is this clear to you all? All these steps? Okay, I am assuming that you have understood, so I am proceeding further. Okay. Now, we have done this. What are the benefits of this decision, or what can be the benefits, right? So, what can be the benefits? See, first, more transparency, as you all know, because less of rumors, more accurate the prices, more transparency and fairness in the market for investors. So it will provide more transparency and fairness to the investors. Investor will be able to calculate their loss, profit, or speculate basically. You know that stock market or share market works on speculations, right? So they'll be able to speculate more rationally. Are you getting my point? Then no unduly influence on investor decisions. Unduly. So rumors have unduly influence on the investors' decisions. But now when you don't have the impact of the rumors, you know this is the unaffected price. So investor knows that this is the unaffected price. So it is not based on any false information that would not unduly influence the investor's decision. Right? Next, greater stability for companies and more investor confidence. See, because share stocks are issued by whom? Companies. When their volatility reduces, so companies have more stability in the market, financial market. So when there is more stability, remember, although investment comes with risk, these are two sides of the same coin. You cannot eliminate risk from investment, right? Investment risk is very inherent in investment term, right? But you can reduce it to certain extent or depending upon the phenomena, right? So we are saying that when there is a stability for companies due to this unaffected price, that would increase investors' confidence into companies. Investors would want their money to be invested. So we will attract more investments of all kinds, say institutional investments, portfolio investments, through foreign investors as well as through domestic investors. Yes, more foreign investment, direct relation, right? Then more effective regulation of the market. Now see, if the regulator has to regulate the market, the regulator also has to know that okay, this is the thing. When there are unnecessary fluctuations that affects the regulation by SEBI, so it would be helpful for the SEBI as well in doing more effective regulation of the market, which will lead to less manipulations and more market integrity. So more effective regulation, lesser manipulations in the market, less manipulations, less unnecessary losses, more market integrity, people will have, investors will have more confidence into your market. So ma'am, we calculate VWAP before rumor and then compare it after rumor, according adjust the WAP. Yes, so we first calculate the VWAP in a standard manner as we have been doing since time, okay. We do that, then we adjust it for the price fluctuations. Adjust means reduce the price fluctuations which you have observed. Then it gives you adjusted VWAP, which then can be used as a standard for declaring the unaffected price. Is this clear now, Gurleen? Okay, so Shyamanand Kumar, it will be calculated for the past data. Okay, since the opening of today's market till the closing of say tomorrow's market, okay, then the adjustments done, right? Because you need some benchmark to compare it. Are you getting my point? Right? So all your doubts answered, everyone? Okay, so this is the benefits which you get. Any more queries till this point? Any doubts? No? Okay. All right. These are the benefits. Now, what are the challenges? Although these are the benefits, but there are certain underlying challenges as well. What can be these challenges? See, accurately identifying market rumors. Yesterday, I said something in the class. We were discussing revaluation balances, right? And I said something which is risky cannot be used to manage risk, right? So some of you have liked this line so much. Even I didn't know what did I say. Okay, I just framed it on the spot. So today, similarly, I am saying something, but don't get very obsessed with it. I am saying that, you know, rumor. What is a rumor by itself? Rumor is something which does not has a specific origin, and you are trying to trace the specific origin. So again, you will be quoting this line, right? Rumor inherently is something which has no authentic or specific origin, but you are trying to trace the specific origin only to address the fluctuation issue. So that's the irony. Are you getting my point? Okay. So that's the irony, right? So you need, if you want to accurately identify the market rumors, that is a challenge for us. Yes, like chasing a ghost. Yes. Before this framework, what are the measures taken by SEBI? See, SEBI has been very active in addressing these kind of manipulations, but this is a very substantial decision. Okay, we cannot go into entire guidelines issued by SEBI before this. You can read about them, but this is very substantial going to be implemented, Aditya. Okay, there have been efforts and attempts. It is not that only first time you are getting concerned about price fluctuations, right? How we will get to know about rumors, even SEBI. Yeah, so that's what I am saying, that it is something which would be difficult to do, but if you are able to do this, that would be really very beneficial for your market. Are you getting this point? Okay, effective implementation and enforcement. So again, when you initiate something, implementation also becomes important. And but so lastly, I am saying that benefits are substantial and worth taking risk for. Although there are these underlying challenges, but the benefits are more. So you can take this risk of implementing this, and taking risk and then having a trial and error would be more better than just sitting and thinking about the solutions, right? So benefits are more than the challenges, so it would be worth taking risk for, right? Okay, so that was regarding this editorial or this news. Now tell me, are you able to understand the news now? All those who have read this news earlier but didn't understand, are you able to get it now, what is happening, right? You need not to be, just one thing, one suggestion from very core of my heart to everyone who is preparing for any competitive exam, right? Any competitive exam, just one suggestion. There is a difference between an academic exam and a competitive exam. Okay, what is the difference? While preparing for academics, you try to be specialist in a subject. You are doing PhD, MA, MPhil, etc., etc. Okay, but if you want to get selected very fast and do not waste your years while preparing for competition, never try to be specialist in your subjects. Just get this point. Why am I saying that? Be it UPSC, be it NABARD, be it RBI, be it SEBI, any exam has to be approached from the point of view of examination only. You only need to do what is required in the examination. Don't try to cover everything under the sun and try to be specialist, particularly the subject which you are interested in. No, it might happen that the questions from your own subject are very difficult in the question paper. So don't waste your time that, don't take it on your heart. Don't take it so seriously that I am economics student, I need to solve every economics questions. No regulatory body or any examination body is going to award you for that. Are you getting my point? You just need to qualify the cutoff. So prepare rationally and within the human capacities. You have a capacity being a human. You cannot remember everything. That's why I am saying don't try to be specialist in all these kind of news. Just need to understand the phenomena, and if you are able to understand such technical issues, that is far more better and more than required. And even if you are able to understand them and simultaneously relate them with other phenomena and apply them into the existing problems, that is more than sufficient for you, right? So this was just a genuine suggestion from my side, from my experience, so that you do not waste your years, your precious years of life, because life is precious, more important than any exam, anything else, any ambition, right? So remember this. Now moving ahead to your next editorial which I have picked up for today. So that was it for your unaffected price mechanism. Everything we have done. This I have taken up from The Hindu. Okay, so The Hindu editorial page. Now this is also an important phenomena in economy. We are limitless. By the way, you are phenomenal teacher. Okay, thank you so much. It gives me motivation when you appraise such efforts, right? All right. Anyways, all the other things apart, just try to focus on the editorial. This is the tagline, less to save. Gayab ho gaya. Okay, less to save. Now, why have I picked up this editorial? Has a reason behind it. I have sometimes in the analysis of previous classes given you hint about household savings. Household savings. So this is from The Hindu. You can go and read about it. Household savings are very important for any economy. So on household savings, there is a new data available which is highlighting some glitches at present in Indian economy. So we will try to understand those glitches and what can be the consequences for Indian economy. That is my concern. Okay, so that's why. Now the title of the editorial, as you can see, is Rising Debt Strains Household Savings. So rising debt, rising loan on households is leading to less household savings. This is the main concern of the from the data which is provided. Okay, rising debt and less household savings. So as you can see here, household net financial savings to GDP ratio has declined due to increased borrowings, structural reforms, right? But that is a concern for Indian economy. So what is this net financial saving to GDP ratio? What is debt to GDP ratio? Why is it a concern for any economy, and why the government needs to address that? Are you getting my point? So this is the editorial. Now we will look at the key points. There is a huge data provided here, need not get into that. Okay, first thing, the household net financial savings to GDP ratio fell significantly. So the author is saying that net households, and we are particularly talking about the household savings, right, not the other savings. Households net financial saving to GDP ratio has declined in 22-23 as compared to the previous levels. So this is the concern. Now what is this ratio? What is net financial saving of household? Let's try to understand, then we'll come back to this. Net financial savings to GDP ratio. You all know what savings are, right? So technical definition, if I give you, say suppose this is your income, y is equals to c plus s. Income is equals to, your income has what? The income which you earn is either spent, which is consumed, right, or it is saved. Suppose you are earning 60,000 per month, 40,000 you are spending, okay, 40,000 you are spending consuming anything, right? So your C is 40,000, this is your 60,000, 40,000, and your saving is 20,000. So saving is that part of income which is not spent. Are you getting my point? What is saving? Saving is that part of your income which is not spent. So you save it. But in economics, savings which we are concerned about are not those savings which are lying there in the somewhere in between the atta or chini ka dabba or chai ka dabba, right? Or in between pulses or any other grains. Okay? The hidden savings in the households. No, the savings which we are concerned with are the savings we deposit in the banking system or we invest in the financial market. Are you getting my point? So that saving is important for driving the economic growth of any economy. The saving lying in some dabba is not helpful for economy at all, right? So this is the saving which we are concerned about. Now, what is this net financial savings to GDP ratio? It is nothing but when you divide net financial savings of households with the GDP and into multiply by 100, it gives you net financial savings to GDP ratio. Simple. So your net financial savings of households we are talking about divided by GDP, your GDP. You all know what is GDP, right? You all know what is GDP? GDP is gross domestic product. What is this? Is full form, but not the explanation. Gross domestic product is nothing but all the production of final goods. Remember, final goods, not the intermediate one. No, never. In national income calculation, only final goods are taken into consideration. Always remember, note this point. So GDP is what? GDP is the production of goods and services, production of final goods and services within your boundary. Domestic means no, we are not considering the outside or outflows or inflows from foreign. We are in GDP, we are just concerned about production of final goods and services within your political or geographical territory. Are you getting this point? By your factors of production, land, labor, capital, entrepreneurship. So that output is only GDP, which is also national income. Although we do some changes to calculate national income, which is NNPFC, but we will not go into it right now. Are you getting this point? So this is GDP. GDP means nothing but the output in your economy. So when your output is rising, we say that national income is rising. And we say that there is growth in the economy. Why do we attribute rising GDP to economic growth? Because GDP increasing, C plus I plus G plus net exports. Yeah, that is national income as well. Yes, you can say. Okay. All right. So what was I explaining? I was talking about GDP, yes. Why higher GDP leads to higher economic growth. More GDP means more output. More output means more economic activities are going on in your economy. That means more employment is being provided to people. That means people are able to earn more per capita income, more national income. Simple, right? But, so this tells you that how much proportion of this changes when you have increase in your GDP, say, for example. So if your economy is growing, by how much proportion of that growth your household saving is also growing. So if it is not growing, it is a concern, because then there is a glitch. Your economy is growing, your GDP is growing. Why isn't the household savings growing? Are you getting my point? So this net financial savings to GDP ratio basically reflects the proportion of savings by households and businesses. So here the definition is broad, that's why business also included, but we are only talking about household saving. So proportion of savings by households relative to overall size of the economy. Relative to overall size of the economy, which is GDP. Are you getting this point? What is this net financial saving to GDP ratio now? So how much proportion of savings are there in respect to your GDP growth? This is your net saving to GDP ratio. Is this clear? Let me know so that I can move on from this point. Anyone? Okay, very good. Then what are these savings which we are talking about? Household financial savings. These are the savings made by households. We all do savings, right? We are households only, including individuals, family. So in households we can have individual as well, and we can consider family as a unit as well, right? Savings in various forms. So savings can be the savings in your bank account, which is your bank deposit. You all deposit your money, right? You can have your investments, that is also a saving, and other financial instruments, because you have invested it, it will earn for you. You have not spent it. Remember, earlier only I said why I am considering investment as saving. Why are we saying that investment is also household saving? Investment by household, because when I say that what is saving, by definition saving is that part of income which is not spent. Investment is not expenditure. You have a difference between expenditure and investment, right? आरबीआई का डिविडेंड ज़्यादा हो गया तो वो जीसेक बॉन्ड के इंटरेस्ट रेट को भी अफेक्ट करता है? हाँ, कर सकता है, बिल्कुल कर सकता है, राइट? ओके, तो अभी हम उस न्यूज़ पे ना जाते हुए लेट्स कम बैक टू दिस. सो आई एम सेइंग that why are we considering investment as saving? Because this is not expenditure, this is investment, right? So that part of income which is not spent is saving by definition. So these are your savings, your investments, your bank deposits and all. Why are they reducing? So the editorial talks about reduction in your net financial savings of households. It means that households are unable to save more. Okay, unable to save more. Why? One of the reasons attributed in the editorial as well, if you see the editorial, one of the reasons attributed to this low saving is higher borrowing to GDP ratio or higher debt to GDP ratio. Debt to GDP ratio. Now try to understand. Very interesting linkages are there. What is debt to GDP ratio? First understand this and then we'll move further. What is debt to GDP ratio? As the name suggests, that how much debt is there on your economy or your government as proportion of the GDP. Debt to GDP ratio measures total debt, both public and private we are talking about, okay, relative to country's gross domestic product. So in relation to your GDP, how much total debt is there on your country? We are including government debt as well as the okay. So just first let me explain the editorial which I have taken up for today. and we'll address this question as well. Okay, how does it affect the other bond prices and all? Okay, right? Now, so what is debt to GDP ratio? It measures the total debt. So in total debt, we are including both public as well as private debt in relation to your GDP. That how much is your total debt in relation to your GDP? Are you getting this point? So it basically reflects the level of indebtedness in the economy. If it is higher, it means more indebted you are. Are you getting this point? Yes or no, everyone? So when this ratio increases, it indicates that the economy is accumulating more debt. And when you are accumulating more debt, that means your borrowings have increased. You have liability to pay. Are you getting this point? You have liability to pay. It includes public debt as well. So government's liability to pay has also increased. We have already seen in the previous fiscal deficit and other editorial analysis that when fiscal deficit increases, it is nothing but the borrowing increases. So when borrowing increases, government increases its borrowing from the private market as well in order to repay the debt. Are you getting this point or not? Just let me know so that I can explain now everything to you. So this is the reason given in the editorial or in the figures which have been released, that it is high debt to GDP ratio, that households are unable to save more. Now why this high debt to GDP ratio is leading to less household savings? I am just trying to explain that. Okay. So it is because when debt to GDP ratio is more, that means you are indebted. Your debt accumulation is more, right? So on government as well, there is more debt pressure. Government borrowing is increasing. Okay. When government borrowing is more, government takes loan from the market as well. Yes or no? We have discussed in the crowding out effect. We have discussed the crowding out effect in the earlier classes of editorial analysis only. Yes or no? Anyone there? Yes. So you must be remembering crowding out effect. So government wants to borrow more from the market. Borrow more from the market, private market. And from that market only, which is our banking system, right? For example, the limited amount of credit is available for private investors as well. So same amount is available whosoever borrows it. When government increases its borrowings, we have understood what is crowding out. This is the crowding out only, right? So when government wants to borrow more, now less is available for private sector investors or private investors or private borrowers. Yes or no? Say this much amount was available earlier for everyone to take credit or to borrow from, but now government borrows this much. So only this much is remaining for private investors, only this much, isn't it? So it has been reduced. So they'll not be able to take the loan from the market. Yes or no? So what will happen? Less loan available, more people who want to take loan, interest rates will go up. Bank will also try to earn from this situation. Yes or no? Borrows from foreign country, yeah, that can also happen, but that would be a lesser possibility because you are addressing the problem due to more foreign borrowing only. Suppose you have borrowed more from foreign and that is why your debt to GDP ratio has risen. Okay, you cannot borrow seamlessly from foreign countries. You can have World Bank, you can have other banks, but they are not always available to finance you. Okay. If you go for that option, you again increase your debt to GDP ratio. So the problem will not get solved. Are you getting my point? You have options to borrow from outside, but that would increase your indebtedness only. Yes or no? Right? So in this case, you see, this is known as crowding out effect. crowding out of funds for the private sector. So availability reduces, right? Interest rate increases. Now see, interest rate increases. Now the connection is here. Listen carefully. Higher interest rates, households who have been taking loan with flexible interest rate agreement or who are going to take up loans have to pay more interest. More interest you have to pay out of your income, less proportion left to save. Are you getting this connection right now? Less to save due to higher interest. That's why one of the reason is higher debt to GDP ratio. So less savings. Yes or no? Got the linkage? Right? Right? Okay. So that's why now if you see why debt to GDP ratio, why debt to GDP ratio is resulting in less household savings. So first reason, interest rates, as I have explained it to you. Okay. How? Higher interest rates, people have to pay more as interest. So due to increased borrowing, you are able to save less. Simple. As the government or private sector borrows more, interest rates tend to rise. Yes or no? Okay. Now, higher interest rates can reduce households' disposable income. So, what is disposable income? Disposable income is that part of your income which you can use or spend at your own will. Which means, suppose you earn 1 lakh and you have to pay 10,000 as tax on 1 lakh. For example, so your disposable income is only 90,000 because 10,000 is not your income. It is a duty which you have to pay out of that income. Okay. So when you deduct all your liabilities, your tax due liability and fees and everything else, then you get your disposable income, which now you can spend on your will. Okay. You are not liable to pay it to the government. So your disposable income reduces. Suppose you are earning 60,000, you were able to save 20,000, but due to increase in interest rate, now you are able to save only 10,000. So disposable income reduced, right, which can lead to reduction in savings. One of the reasons can also be the crowding out effect, which we have discussed in the earlier classes only. I have explained again that when government borrows more, what happens is less is available in the market for private borrowing. So it reduces the availability of credit. This is known as crowding out effect. It can also lead to higher interest rates. So this was the entire story, and that's why we are saying in this, now coming back to this editorial, that this is the thing, that household financial savings, net savings are reducing due to increase in debt to GDP ratio, and this is a concern. Why? Because savings are important. By now you all know that when you save in the banks, bank have liquidity. Out of that liquidity, bank gives you credit. So if you have less savings in the banking system or through investments, you have less liquidity in the market or in the banking system. Less liquidity means more risks. Bank will not be able to create more credit, the process which is known as credit creation in banking system, right? So this directly affects your banking system, directly affects your growth, and directly affects your investment. That's why you need to address this situation, provide people with more employment, such employment which increases their income. Because now when your income increases, then only you will be able to save more. It is hard to cut on the expenditure due to rising inflation, right? But you can increase your income so that the proportion of saving increases. That's what the editorial was talking about. Yes. Right. So due to high interest rate, major chunk goes in the interest payment only. Simple connection. Okay. So that was it for this editorial analysis, an important analysis which you need to understand how things work in the economy. Okay. So these were the editorials today for you. I hope that it was helpful for you. Okay. And those questions, we don't have much time. So I would try to address this question in maybe next class. Divyadarshi Raj, okay. So that how is it going to affect the bond market, right? कैसे affect करता है, okay. I'll take up your doubt. We don't have much time left in this class, okay? So I might take up your doubt in the next class which we have tomorrow, right? Okay, so rest assured, I'll try to answer your doubt tomorrow, and I think all other doubts have been taken today, every question answered, and that is it for today's session. The earlier news is also very important, the unaffected price, very important. So just read the PDF again which you get in your Telegram channel, these slides, and try to understand the phenomena. And thank you so much for staying focused, staying tuned for so long time, and I'll see you in the next session tomorrow. Till then, goodbye, wish you good luck, have a great day. Thank you.